You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome back to Options Playbook Radio, the program here on the old network where we break down the interesting, sometimes scary world of options into easy to understand, easy to use plays that you could utilize in your own portfolio. Maybe you want to do a little bit of speculation, generate some income. Maybe you want to go on offense. We got you covered there. Maybe you want to protect your gains. Maybe you want to lock in some of that upside and you're worried about a little bit of downside in the portfolio. We want to do a little bit of hedging. Got you covered there as well. My name is Mark Longo from the aforementioned network, as well as, of course, from the newly revamped theoptionsinsider.com. Hope you like the new look, the new sheen, the new coat of paint we put up over there. And if you're saying to yourself, he's not the usual host of this program, you are correct. So allow me to introduce your regularly scheduled host, Mr. Brian Overby, the senior options analyst, a.k.a. the options guy, over there at Ally Invest. Mr. Overby, welcome back to your own program, sir.
Well, hello, Mark. Thank you for that great introduction, and I always appreciate when you can step in and you can help me answer some listener questions. That's probably one of my favorite shows to do because we get so many questions as people are listening to the show. It gives us an opportunity to huddle up and answer some of those questions.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody, welcome to the huddle. Like Brian said, this is the portion of the show where you guys take the reins with your questions, your comments. We've done a few of these recently. They've been very well received, so we're happy to do some more here for you. Brian, we'll see how many we could burn through on the episode today. The mailbag, we've been doing mailbag episodes, and it keeps filling up. So we keep shoveling. It's like a boat with multiple holes. We keep paling out. It keeps filling up with water. But I guess that's a good problem to have, right?
Well, it depends on if you're a boat owner.
Yeah, that's true. That's true. You are a boat guy, so you would probably instantly go there in your mind. That's true.
Yep, without a doubt.
From a mail analogy perspective, I think it's a good problem to have. All right, let's see what we got on the docket. Let's see what we got on the docket this week. First off, we got a question that came through you guys. Actually, one of your customers there, an Ally customer. And he wants to know, I tried to do the short credit spread on RUT with my options account at... let's just call it Broker X, Brian. There was almost no open interest on the September 27th expiration, so I abandoned that. I then looked at the monthly, which Broker X says expires on September 19th, not September 20th, as your Ally research turns up. So my first query is why? And then he goes on to write, all of the options prices on RUT for September 19th versus your September 20th were vastly different, though the credits for the spreads were close. So my second question is why? And Brian, this is one of those questions that kind of reveals the hidden underpinnings of the options market, right? The devil, as they say, is in the details, and that is very much the case with this question. So why don't you go ahead and regale our ally customer here with what the heck is going on with RUT options?
Well, and this is actually an issue with a lot of indexes in general, but the exchanges have decided that no matter if the underlying is considered an AM or a PM settled option contract, that that all of those options are going to be displayed under one chain. So for the Russell, the symbol is RUT. If you type in an RUT into the option chains and you look at the September 20th expiration, you'll see that it's an AM settled option contract. Now here's the problem. The weeklies are a PM settled option contract. So they have weeklies that are PM settled and they have monthlies that are AM settled, but they display them all throughout the chains. So if it's an AM settled option contract, well, then that means that they stop trading on Thursday the 19th, and the settlement price is determined on Friday the 20th. So as far as brokerage firms across the country, they all have a tendency, there's no real set standard as to how you're going to display those option contracts. Do you display and say, well, the expiration is the last day of trading? Or do you say that the expiration is the last day where they actually settled the option contracts? So it's important to note that on the 20th, you cannot trade the September 20th AM settled option contract, but you can wait around to see how the Russell opens up and see what the actual settlement value would be to determine if your option contract is in the money or out of the money. So this has been an issue ever since the advent of weeklies, and where it really first came in is in the SPX. They started out and they decided at the Chicago Board Option Exchange that they were going to have a PM-settled SPX product, which has by far been their most popular index for many, many years. And because of that, they decided to have a symbol that was SPX PM. Now, that to me made a lot of sense in that you're separating out the SPX product, which is AM settled, which has been AM settled since the beginning of time, and you are separating those option contracts from the ones that are PM settled. And that made a lot of sense to me, but the Chicago Board Option Exchange came out and decided that we need the marketing power of the SPX symbol. So let's just go in and throw all of this in and make a big pile of soup, which can get extremely confusing, especially for retail clients. And myself, if you want to consider myself a professional, I've done this many times where I've gone in and been looking at a strategy and really wanted to deal with the PM settled option contracts, but ended up buying the AM settled by mistake. And that does happen. Now, the Russell, in their option chain on the September 19th, they do not have a PM settled contract, but in the SPX, they do. So even across the indexes, it gets confusing as to which one does have a PM settled monthly and which one doesn't have a PM settled monthly. So with all this being said, if that was a little bit of jargony for you, don't worry. We have the options playbook. You can go to the options playbook and go into managing your positions, and you can look at what is an index option. And it talks about the cash settled and talks about the AM and versus PM. The good news is that in stock options, they're all PM settled. So the confusion isn't really there in the stock options. It's really only exists in the index options world. But bottom line is if you see two options with the same expiration and it seems odd to you, it's because it is. And you need to stop, take a pause and do a little bit of research and figure out what option contract that you're trading. So with all this being said, what I would really like to see the exchanges do is change up the symbols and get the PM settled options out of the AM settled chains and vice versa, and come up with a better solution so there's a lot less confusion in these index option chains, which are so popular for option traders overall.
Yeah, I agree with you, Brian. This confusion benefits no one. The least of which the exchanges. They want to get their volume going. Luckily, I have some pull over there with the Russell folks. Sean, who heads up the Russell Derivatives division, is in my studio all the time for our TWIFO program. So I'll have to put this to him and see if he has any insight into why this is being displayed differently. I think your answer is the correct one, but maybe behind the scenes we can get some action going to maybe try to rectify this, because I don't think he wants confusion in his products either. We just had Rick Rosenthal from the SIBO in the studio a couple weeks ago, who also heads up the Russell, the business development. Russell, another one of these products where the history is kind of long and tortured. It was dual listed. Now it's singly listed at the SIBO. So there's a lot of other behind-the-scenes machinations going on with Russell. But in general, I don't think anyone wants this. Maybe we'll even talk to OCC, because they're the kind of the standard bearers for how these contract specs should be displayed and unfolded. And maybe between the three of them, you're right, we don't want anyone trading the wrong thing by accident. They're being confused by these types of prices. So this is a good question. I don't have the name of this customer here, but good question here. Maybe we'll see. Maybe your question will lead to some change for the industry as a whole. And then all your fellow question writers could write in and thank you. See, Brian, that's the power. That's the reach of OPR. Ask and maybe, potentially, it shall be done, sir.
Well, and I do have one little last thing. I mean, it would even be, I don't really mind if you think you need the marketing power of having all these in here, but why not make a chain to make it simpler? So if I want to type in SPX PM, guess what? I only get PM settled products. Like, I want to type in Russell AM, I only get AM settled products. I think it would just help out quite a bit. It also helps out the margin departments here at the brokerage firms too, because you don't want people spreading AM settled options off with PM settled options. They just don't have the same risk. Each option contract is individual and different.
Yeah, that's another thing. Yeah, brokers don't want that. They don't want.
Right.
No one wants this. So yeah, maybe we can get some wheels spinning here. All right, let's keep rolling here. Next question comes from No Beta. I like that handle. He doesn't want any beta, just alpha, Brian. No beta for this guy. He says, Brian, thank you very much for producing such a fine program. I enjoy listening every week. I would like to know more about calendar spreads, in particular short calendars, where the customer sells the longer-term contract and buys the shorter-term contract. It seems like everyone talks about calendars from the other perspective. Why is that? And do you ever use the short calendar in your arsenal? Thanks again, and please thank Mark for creating this network. Well, thank you there, Mr. No Beta. Your thanks are appreciated, as always. But he's got a point, Brian. This is kind of, I would say, 99.9% of the use cases for calendars that we discuss and that we hear from our audience is always the other way. It's going to be the typical long calendar, buying the longer duration contract, selling the nearer duration contract. I think there's a lot of reasons for that. A lot of people, I think, maybe rightly or wrongly, depending on your viewpoint, they view calendars as kind of a cheap way to finance the longer-term position. So they view that short leg as, hey, we're selling that in the near term, selling that in the near term. Maybe they do it a few times, and they hope that kind of ends up with a cheap or even a no-cost long position at the end of it. So that's why a lot of people enter into calendars with that mindset, I think, which is why they always or predominantly talk about them from that perspective. I think the other side of this is that the other side of that calendar, the selling the longer duration, buying the nearer term, I think it's a little more difficult for people to wrap their heads around that one. That's a little bit of a different scenario. Your typical calendar, you buy one, you sell the nearer term, you can kind of wrap your head around, I want it to sit for a while, and then I expect it to move. People can wrap their heads around that. Flipping that around where all of a sudden now you're long gamma, you're short vega, it's not exactly the most intuitive. I think that also helps for why it's not perhaps the most popular use case. But maybe let's start there, Brian. I know you talk about calendars in the playbook. Do you have a chapter or a section on, maybe we can call them reverse calendars or short calendars? Do you discuss those? And what are your use cases for these? And do you agree maybe why you think they aren't as popular as your traditional calendar?
Well, it really just comes down to margin. We do not have the use case inside the options playbook, and here the biggest reason why is that the brokerage firms, almost all brokerage firms, consider this a naked call option. If the option that you are selling expires past the option that you are buying, you are net naked that option contract. You are not considered covered. Now, rightfully or wrongfully, that is the rule. And so when I look at the options playbook, I think of it more of a retail trader's playbook. We do mention naked calls and we do mention naked puts, but only because those are strategies that people need to know a little bit about and why they might not want to do those strategies. And it's all about the unlimited risk of a naked call option and the substantial risk of just being flat out naked a put option contract. So that's the biggest reason why you don't see a lot of people talk about them is, first of all, you have to be approved for that level of trading, naked call options. You cannot do them in IRA accounts, so that takes out a big chunk of option traders. So any type of retirement account, they do not allow you to do anything that would be considered naked. So it really it really compresses the people that can do that type of trade. So a lot of people like me just don't talk about them because of this complex margin requirement that all the brokerage firms apply to these type of strategies. Now, with that said, it would be interesting to do that, and we have had clients that will come to it, well, I'll just close it before the first expiration date. And that's all great that you say that you will close it, but i.e., most people in the world, if you say you will close it, there will be somebody that forgets, and they will end up getting naked that option contract, and they will end up having a quote-unquote infinite loss. That will happen at the brokerage firms, and brokers are always worried about the bottom line about all their clients, and so these type of trades they just like to avoid.
So I like having you on here, Brian. You also bring the brokerage perspective, which is important for people out here. You know, margin. We're talking about a lot of deep in the weeds stuff today. We're talking about contract specs and settlement and margin. But, you know, these aren't the most sexy of topics, but these are, as people discover them, they start getting a little bit more experience in the options world. These are very important topics, and they can make the difference between making a big error, losing money, making money. So it's important that we clarify these types of issues, too. It's not all Tesla iron condors, Brian, right? All right, I think we got time for one more. This is a pretty epic one, so we'll see what we can do here for Mr. Owen Jones. Owen says, hi. Hello, Owen. I'm a new options trader, and I have a question regarding some paper money options I have been trading. I have two questions regarding these, but first I will outline the trade that I executed. I bought 10 of these September SAM 390 call. SAM is the Boston Beer Company, a.k.a. Sam Adams, all those good types of beers out there. It's stock right now currently trading $4.38. I think this question came in maybe a week or two ago. I don't know exactly where the stock was then, but probably north of the 400 level. I'm going to go out on a limb and say when this question came in. He says, I bought 10 of the SAM 390 calls. I paid $17.75 for those. Simultaneously sold 10 of the Dees SAM 430 calls. So he bought 10 of the SEP 390s for $17.75, sold 10 of the Dees 430s for $19. He's got kind of a bit of a diagonal vertical, if you will. a calendar diagonal, calendar vertical. His first question actually is that. He says, what type of option strategy is this? I have the Ally options playbook, and it seems it is kind of a long call spread, but it is the inverse, because I am selling the far out option and buying the near term option. Well, not necessarily. Second, he says, I'm not sure what I'm missing, if anything. I am purchasing the near term contracts for the premium of the sales of the far out options, so the cost is already a credit to me. But what is my total risk profile of how much I can lose? I suppose if someone calls the options early from my December 12th call sale, I made this trade because the Vega was quote unquote high on the far out options, and the idea of getting already paid for the calls that were at the money initially, so the stock was around, looks like 390 when you did this, that were at the money initially made this enticing. Can you also talk about exit strategies on this? Sorry for the lengthy email, but I'm just trying to learn more about options and would like this whole idea illuminated a bit. Thanks in advance, Owen. So, Brian, Owen is reading the playbook, and somehow, through reading the playbook, he decided to leg into this diagonal, I guess. Let's just reiterate what he did here. He bought 10 of the SEP 390s for $17.75 in SAM, and then he sold 10 of the Dees for $30. So he's buying a vertical, listeners, but instead of a traditional vertical, it's more of a diagonal. And he's confused because he's collecting more for the Dees contract than he is paying for the SEP contract. There's a lot of reasons why that is. First off, Brian, what chapter is this in the playbook? I want to go read this. And then secondly, what do you think of, what was the name, Owen's kind of funky diagonal vertical here, sir, where he's getting a credit to do it?
All right. Okay. First of all, I always like, and you threw out a couple of terms, like you talked about verticals versus diagonals. And one of the reasons why people mention them that way is that if you're on the floor of the Chicago Board Option Exchange or any exchange in general, if you're looking to quote this and it's the same strike but different expirations, you're looking at the board and you're looking vertically across the board. And that's basically, the same expiration but different strikes, you're looking up and down, which is vertically across the board. Now, when you talk about a diagonal, you're looking at one expiration and a different expiration. So on the board, you're actually looking diagonally to see both of the quotes, and that's where those terms come from. And I think that kind of helps with the understanding of the trade. But this is actually a great question to go along with what we just talked about earlier, in that if you buy the shorter term option contract and you sell a further out option contract, you are going to be considered naked that longer term option. The brokerage firms don't care when you get out of the trade or when you plan to get out of the trade, but overall, they just say that you are naked, and they're going to require you to have the approval to do uncovered call writing, and they're going to charge you a large requirement and also charge you to pay for the long option contract. So it becomes very expensive to do this type of trade. So with this, overall, we're looking at a September, and I'm looking at the earnings date. I'm seeing the earnings date just by pulling it up on the Ally Invest website is somewhere between October 23rd and 28th. They don't have it posted officially. So what you're doing is you're buying a September option contract that does not have the implied volatility jacked up in it because of the earnings, and you are selling an option contract that expires after the earnings, and you're getting a little bit more of a jacked up implied volatility. Now, I personally haven't traded this underlying, so I don't quite know where the normal volatilities would be at, but that's the first thing that I see that would be an explanation for the difference in prices. But then again, also, if you're looking at this, it's important that you noted that it was a paper trade, and if you were to try to execute this at a brokerage firm, you'd run into a lot of headaches.
Yeah, that's a good point. I mean, the paper trading is always fun. We encourage everyone to do this. I should point out Owen here is doing this in the paper account, as he points out, so he's not putting real money at risk on this. I think if he did, he would discover, as Brian mentioned, that it is a very expensive trade to do, which is another reason why we don't talk about these types of diagonals very often, because you're right, one contract is nowhere near long enough to cover the other, as you would be in a traditional vertical, so you have all sorts of additional margin costs that you wouldn't have with a traditional vertical. And it's also a bit of a weird one to get your head around. And this is not unusual for stocks to have, strange volatility term structures. Brian just mentioned one of the common causes, which is earnings. There could be other corporate events or actions or calls or meetings or conferences set up, which will cause little blips in the term structure like this. The volatility could be higher in certain months than others. And as you look at that whole graph of all of them, month to month, that shows you what is called the term structure of that name. It's not unusual for names to have strange blips like that. It's worth paying attention to if you are someone like Owen, and maybe this is the right strategy to be selling that type of volatility. I don't know if doing it this way is ideally the way to go. Maybe a more traditional calendar where you can wrap your head around that a little bit easier might be a better way to go. Obviously, if he's doing a strategy where he doesn't really know all of the nuances therein, I would probably encourage him not to do this for real, because it's not the way you want to go. You don't want to learn with real money on a strategy that you haven't really tried before. I think staying with traditional verticals or a traditional at-the-money, same strike calendar is a better starting point than this kind of funky diagonal, which brings up all sorts of unintended costs and consequences that I don't think you really want to deal with. Glad you're listening. Glad you're reading the playbook here, Owen. We appreciate all you guys writing in. We probably spent another hour answering questions, Brian. We got so many. We'll have to save some for next time. But before we go, Brian, if others want to join the queue, they want to get their question answered here on the program, maybe they just want to hit you up in between Huddle episodes and ask you a question directly, where should they go? What should they do?
Well, all they have to do is send me an email directly. My email address is theoptionsguy@invest.ally.com. I want to say thanks for listening, and Mark, I want to say thanks to you for hosting, and we'll see you the same time, same place next week.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.